When a currency suddenly surges, it's rarely an accident, it's a loud signal about what central banks might do next. And right now, the Australian dollar is sending exactly that kind of signal. The Australian dollar is climbing against the US dollar for the 6th day in a row, with buyers firmly in control heading into Friday's session. This upswing reflects growing expectations that the Reserve Bank of Australia, RBA, may need to stay cautious for longer, and possibly even consider another rate hike, after a run of hotter-than-expected inflation data. Recent figures showed consumer prices rising for the 4th straight month in October, pushing even further above the RBA's preferred 2% to 3% inflation band and keeping price pressures very much in focus. Why the RBA is back in the spotlight. The RBA is widely expected to leave its official cash rate, OCR, unchanged at 3.6% at its December meeting, largely because inflation is still running above the central bank's 2% to 3% target range. At the same time, policymakers acknowledge that while the unemployment rate has edged up slightly, the labor market overall remains solid and is expected to stay relatively resilient in the near term. That combination, sticky inflation and a still healthy jobs backdrop, gives the RBA room to remain cautious rather than rushing into rate cuts. Market pricing backs up this cautious narrative. As of November 27, the ASX 30-day interbank cash rate futures showed the December 2025 contract trading around 96.41, implying only about a 6% probability that the RBA will trim the cash rate from 3.60% to 3.35% at its upcoming board meeting. In other words, traders see rate cuts as far from guaranteed, and that modest chance of easing supports the Australian dollar by keeping the prospect of higher for longer rates alive. Fresh Australian data keeps AUD supported. Recent credit data from the Reserve Bank of Australia also leans slightly in favour of a firmer currency. Private sector credit rose 0.7% month-on-month in October, beating both the prior outcome and forecasts for a 0.6% increase, suggesting borrowing and lending activity remain reasonably robust. On a yearly basis, credit growth ticked up to 7.3% from a revised 7.2%, pointing to a still active private sector that could keep demand and inflation from cooling too quickly. Beyond credit, broader Australian data has surprised on the upside and is helping underpin the Aussie. Private capital expenditure jumped 6.4% quarter-over-quarter in the third quarter, a sharp acceleration from just 0.2% in the previous quarter and well above expectations for a modest 0.5% gain. At the same time, the Australian Bureau of Statistics reported that the first, complete, monthly consumer price index rose 3.8% year-over-year in October, outpacing both the market consensus of 3.6% and the prior 3.5% reading, another reminder that inflation remains uncomfortably elevated. US dollar on the back foot, and this is where it gets interesting. While the Australian dollar finds support at home, the US dollar is struggling under the weight of rising expectations for Federal Reserve rate cuts. The US dollar index, DXY, which tracks the greenback against a basket of 6 major currencies, is trading around 99.50 and facing selling pressure as traders shift their focus towards easier policy ahead. According to market-based tools that track rate expectations, investors now assign more than an 87% probability that the Federal Reserve will lower its benchmark overnight rate by 25 basis points at the December meeting, a dramatic jump from about 39% just a week earlier. Recent U.S. data helps explain this dovish turn. Initial jobless claims fell to 216,000 for the week ending November 22, down 6,000 from the previous revised figure and better than expectations of 225,000, while the 4-week moving average eased slightly to 223,750. On the inflation front, the Producer Price Index, PPI, stayed at 2.7% year-over-year in September, matching both forecasts and August's level, suggesting price pressures are no longer accelerating. Core PPI, which strips out more volatile components, slipped to 2.6% from 2.9%, undershooting expectations for 2.7% and reinforcing the perception of stabilizing inflation. U.S. consumer and growth data add further nuance. Retail sales increased 0.2% month-over-month in September, slowing from a 0.6% gain in August, which hints at more cautious household spending. Meanwhile, the Conference Board reported a sharp drop in consumer confidence, which fell 6.8 points to 88.7 in November from 95.5 in October, indicating a notable deterioration in household sentiment. Fed tone turns more cautious, but here's where it gets controversial. Federal Reserve officials are starting to sound more worried about growth and jobs than about inflation. Fed Governor Christopher Waller told Fox Business that his main concern is the softening labor market and that inflation is not a big problem, given the recent weakness in employment data. He also suggested that the September payrolls number is likely to be revised down and warned that job gains concentrated in just a few sectors are not a good sign, which aligns with his apparent support for a near-term rate cut. Expectations for the future leadership at the Fed are adding another twist. Traders are now assuming not just a December cut, but also 3 additional rate reductions by the end of 2026, especially after reports that White House National Economic Council Director Kevin Hassett is seen as the frontrunner to become the next Fed chair. Markets view Hassett as broadly aligned with U.S. President Donald Trump's preference for lower interest rates, which helps explain why rate cut bets have become so aggressive. And this is the part most people miss. If the market is wrong and the next Fed leadership proves more hawkish than expected, the US dollar could snap back sharply, catching many off guard. Australian PMIs and RBA minutes, steady, not euphoric. Timely business surveys paint a picture of an Australian economy that is not booming, but clearly not in contraction either. The preliminary S&P Global Manufacturing Purchasing Managers Index for November climbed to 51.6 from 49.7, moving back into expansion territory. Services PMI edged up to 52.7 from 52.5, while the composite PMI, which blends manufacturing and services, rose to 52.6 from 52.1, signaling broadly expanding activity across key sectors. The RBA's minutes from its November monetary policy meeting highlight a more balanced stance from the board. Officials indicated they are prepared to keep the cash rate unchanged for a longer period if incoming data remains stronger than expected, rather than rushing into further tightening. This wait-and-see tone may appear less hawkish on the surface, but when combined with resilient growth and stubborn inflation, it quietly supports the case for the Australian dollar maintaining its strength. Australian dollar to US dollar, testing resistance as bulls push higher. In the short term, Australian dollar to US dollar is trading around 0.6540 as of Friday, with technical signals leaning toward a constructive outlook. On the daily chart, the pair is moving within a rectangular consolidation pattern, indicating a neutral medium-term bias, but price has climbed above the 9-day exponential moving average, EMA. That move above the short-term EMA suggests momentum is turning more decisively bullish for now. If buying pressure continues, the pair may first aim for the monthly high near 0.6580, followed by the psychologically important 0.6600 level. A sustained break above this confluence zone would open the door for a push toward the upper boundary of the rectangle, located around 0.6630, where traders would likely reassess whether this is just a range extension or the start of a more durable uptrend. On the downside, immediate support is seen around the 9-day EMA near 0.6504, which is closely aligned with the 0.6500 psychological handle. A clear drop below this area would weaken the short-term bullish structure and could invite a move back towards the lower edge of the rectangle around 0.6420, which roughly coincides with the 5-month low of 0.6414 hit on August 21. A break of that zone would flip the narrative back in favor of the bears. Australian dollar performance versus major currencies. Looking at today's performance across the majors, the Australian dollar stands out as one of the stronger currencies on the board. Against the US dollar, AUD is up about 0.06%, reflecting the pair's recent upward drift. Versus the euro, it has gained roughly 0.14%, and against the British pound, the Australian dollar is showing strength with an increase of around 0.14% as well. The Aussie is also firmer against the Japanese yen, rising close to 0.12%, and has advanced about 0.09% compared to the Canadian dollar. It is broadly flat versus the New Zealand dollar, showing little net change on the day, but up around 0.07% against the Swiss franc. According to the accompanying heat map, you can read each percentage move by choosing the base currency from the left-hand column and the quote currency from the top row. For example, Selecting AUD as the base and moving horizontally to USD gives you the percentage change for Australian dollar to US dollar.